With so much money being printed, it has become quite obvious of the inflationary policies of the Fed. But what if there was one primary factor which was missing in all of this? What if one key ingredient was yet to occur for this reaction to really happen? Well, perhaps that would change everything, wouldn't it? You came here for the truth, so let me unveil that for you. Today we're going to talk about inflation or deflation. This is obviously a very serious topic because the way that you make your preparations may change. A lot of people are doing things based on the fact that they believe with 100% certainty what will happen is that inflation will continue to rise and rise and rise in an uncontrollable spiral. But what if deflation was actually to come first? That's what we'll talk about today. Here's a quote from Jerome Powell. There's actually two that I'll show you. And essentially, when he was asked about the money supply growth, this was his response. When you and I studied economics a million years ago, M2 and monetary aggregates seem to have a relationship to economic growth. Right now, M2 does not really have important implications. It is something we have to unlearn, I guess. And I remember him saying this, and I was shocked. I mean, you don't go that far out to try and tell the lie, but apparently you do. In his testimony with Congress, Chairman Jerome Powell said that historically changes in the money supply level have not affected levels in inflation. Here you can see the question brought to him, M2 money supply going up by 25% in 1 year is going to diminish the value of the US dollar. Powell responded, quote, "There was a time when monetary policy aggregates were important determinants of inflation, and that has not been the case for a long time." Powell added that the correlation between different aggregates like M2 and inflation is just very, very low. And you see that now where inflation is at 1.4% this year, the fake core PCE inflation rate. Inflation dynamics evolve over time, but they do not tend to change overnight. So, you can see what he had said further on. Now, I think it's interesting to see what they say, to see what's actually happening, and to see the difference in between the two. Right now, it is very clear that there is a pickup in inflation. One thing I wanted to note right off the bat here is that when you have to define what inflation is, and you can see that there is the expansion of the money supply in one hand, and that is the technical definition of inflation, the expansion of the money supply. Price inflation is what you get when you go to the grocery store and you see that you used to buy those carrots and they were $1 for a bag, and now they're $1.29, and now they're $1.49, and now $1.99, and you get your inflation over a period. Price inflation. And of course, he's trying to make the correlation, saying that there is no correlation or very low correlation in between the two. Now, I've gotten a very good article actually it's two articles from Real Investment Advice. And they make the case that what we have today is actually creating a deflationary environment rather than an inflationary environment, but it's not so simple. Okay, so we're going to get into it today, and I'll show you that right now. So there's a part one and a part two to this. This is part of the first one. Year over year percentage change, money supply, velocity, and inflation. This is what we're seeing. They're showing you three things. Look for the gray shaded area, that's the CPI. The blue is the M1, and the orange is the money velocity. And what you can see from here, I know it's kind of small, but I'll show you a better chart in a moment. But essentially what we have is the M1, the amount of money that's out there being pumped up like crazy, and yet we have the velocity of money declining. At the bottom, inflation is a function of money supply, but equally critical, the demand for money, in brackets, velocity. Okay? This is important to see what they say in the next part, but essentially just know the way that they define it here, and then that's going to make some sense in a second. They have a whole breakdown with lots of these charts. If I go through them all, you're going to fall asleep. So let me just cover this and I'll show you why I need to explain this. Supply-demand curves. Economists use supply-demand curves to visualize how a shift in the supply and or demand for a good affects prices. As shown below, reducing the production of goods shifts the supply curve to the left. Since demand remains constant in this case, the price rises. The example is econo-speak for, quote, the less of something there is, the more it's worth. And you could see that when you have a limited supply of something, the price obviously goes up, okay? So that's important. That's really key to understand here. But when you have a lot of something, right, what's going to happen to the value? If they print trillions and trillions and trillions and gave it to everybody, what would happen? Well, that's the question, right? That's inflation. But let's look further. The cost of beef, factory capacity, labor prices, and thousands of other factors influence the supply of Big Macs. And they use Big Macs as an example. Its demand curve shifts with the prices of other goods, wages, tastes, and many other factors. Federal Reserve actions, and equally important, the demand for debt and the bank's willingness and ability to lend greatly impacts the supply of money. All money starts as debt. I want to stop there for a second. That is so important. It starts as debt. It is conjured up as debt, not as the whole thought that this money it's out there. Well, really, it's a debt note. When you get those pieces of paper from the bank, it's a debt note. So strange. It's so unusual to think of it that way, but that's the way it is. As such, new debt increases the money supply, while debt defaulted upon decreases the supply. The demand for dollars, known as velocity, is driven by the aggregate desire to save or spend money. Velocity is essential in determining prices and yet is most often neglected. So this starts to shift the way that you think about it, because it's not just one factor about how much money they're printing, but we also must talk about velocity. And I've shown you the velocity before and how that is really, truly a deflationary environment that's being moved in. But you've got the two forces basically battling against each other. How much money is being pumped in, how much money is actually going towards the economy. And then you look at all of the other things leading up to this point. So I'm going to show you the chart from the Fred website in a minute here, but let's look further into this. Velocity matters. On its own, an increase in the money supply is inflationary. However, an equal decline in the demand, velocity, for money completely offsets it, resulting in no change in aggregate prices. So you see that. See the way it works. So they're pumping up the money supply as they are. But if that money doesn't move through the economy, then it doesn't generate inflation. And I would argue doesn't benefit the majority of the people. You see? The media and those hyping inflation tend to solely focus on the supply of money. Rarely do we hear mention of monetary velocity. We revisit the graph below to show the surge in the money supply is nearly perfect offset by the decline in velocity, and that was the one I showed you just a moment ago. The velocity of money has been in a downturn for the past 25 years. It is occurring due to excessive debt levels, low productivity growth, and poor demographics. The result is declining economic growth. That's what we've been having. That's what we've been seeing for this period. I've talked about this over and over and over again. The growth is going down, yet the amount of money that they're pumping into the system is obviously going straight up. By doing what they're doing, they're intentionally creating a crisis. They're intentionally, I will say it right now, because if you study this, if you look at the history, if you see all the details, you know it is very clear. This is on purpose. Looking forward, the surge in unproductive debt and more leverage in the system will further impede monetary velocity. Temporary blips higher in inflation are possible due to supply line problems and fiscal stimulus, but the long-term outlook remains disinflationary for the time being. I want to clarify something. I am not agreeing with anything here. As I always say, I'm simply bringing to you information from these different sources. You look at the M2 money stock velocity, and I had noted, of course, over the many years that this had been declining. So this, from the 90s up until present day, it's declining. Now, of course, we get a massive drop off during 2020, and it started to come up just briefly, but the trend has continued downward. So we'll see how that goes. But what I want to note here is that it's all up to the government, to the Federal Reserve, where they put the money exactly, how they push it out, that determines what happens with that velocity. And now for the Money GPS insight. You see what's happening here today, and investors and people in general should be aware of what's going on. Is this inflation? Is it deflation? Either way, we must always be prepared. We're going to be prepared for an inflation. We're going to be prepared for a deflation. There are many things that we can do, but certainly they have a different way of affecting people. You see, if it's a hyperinflation, that's going to destroy a lot of individuals, but those holding onto assets are, of course, going to at least keep up with that inflation, hopefully, if they hold the right assets. Deflation can affect people in different ways. If it affects their wages, if it affects the price of their home, and now suddenly they're underwater, that could happen as well. You have to understand that neither of these are going to be real, let's say, easy. And I think it's really clear to me right now. There are some, I think the book I read was by Richard Duncan, if I'm not mistaken, and that's Dollar Crisis. And there's also Mike Maloney's book, which was a gold and silver book. Between those two, they made the case for having gold in both of these scenarios, inflation or deflation. Now that remains to be seen. Others would say you want to hold Bitcoin because that's ultimately going to be able to hold value. We don't necessarily know that yet, though, because we haven't seen it through the cycles. I think what is truly important is that we should not overextend ourselves. That is the ultimate key. Do not go out thinking that you've got it all figured out. I'm going to go on this because I am certain this is going to happen. That doesn't end well. And that's what I think people should be ultimately factoring in when it comes to their portfolio. Have money diversified as much as possible, geographically diversified. Diversify into what you believe will, based on what you think is going to happen, and always hedge your bets. Always have a hedge for your bets because you never know. Ultimately, it's usually much worse than anybody ever thought it could be. That's all for this video. If you found that informative, hit that thumbs up button. When you do, you're supporting me. I want to thank you for that. If you want to learn about e-commerce for free, you can do so at the AmazonGPS.com. If you want to know what's going on in the financial system, how to dissect it, how to figure it all out, it's in these two books. You can check them out at the link in the description. If you haven't seen this video yet, you definitely want to catch it. You can click on this and I'll see you there.